welcome everybody to a Gold Leaf Voice of Value webinar off our scheduled quarterly meeting time. We're currently in the midst of a lot of market noise right now, but obviously we're gonna touch on a few things today, different data points that I think will provide some pretty good perspective. So, I mean, obviously, or hopefully, Ryan Hunter, one of the portfolio managers here, Diego Favero, Mike DeBrina, Thomas Bagioni, Alyssa Claremont, and we also have again one of our favorite guests, Rana Chauhan, on the program here. So it'll be I think it'll be a really good webinar, and I think we'll dive into some of the data and get some of our thoughts on this. We also have a new member of the team joining us, Eric LaFortune. I'll let him give a brief intro to himself. Eric, are you
Great,
on?
thanks, Ryan. Yeah, I'm on.
Okay, perfect.
Yep. Recently joined Gold Leaf. 25 years of market experience in capital markets. Spent time both in New York and Toronto. Worked with two major banks, Merrill Lynch and RBC. First decade and a half, worked on a bond trading desk. And most recently worked as both a PM and an investment advisor with RBC. Looking forward to meeting you all.
Thanks, Eric.
Awesome. Good to have you on board. We're pretty excited. I guess we'll start off. I wanted to go share through a few slides. We'll also be sending out a video later today, or it may have already hit your inbox. So we'll a quick video explaining what we're thinking on the tariff and summarizing some of those points. But I'll just share my screen here.
And Ryan, maybe just say this is going to be like a roundtable discussion. What we're hoping to do at the end, we'll try to keep this short, but if you go through the question and answer, you can just click and send us a question. We'll try to answer as many as we can, and hopefully we'll answer most of your questions today. But again, if you do have a specific question, go ahead and ask, and we'll try to answer them as quickly as we possibly can.
Yeah, definitely. Please send through your questions. We'll be monitoring the sort of the chat there. So first things off, obviously, the reason we're all here today, tariffs. Yesterday was Liberation Day, April 2nd. And the US came out with all their reciprocal tariffs that they're going to be imposing on all the other countries around the world, big and small, friend and foe. Our reaction to this is sort of they're a little bit, and speaking with some of the strategists, they're almost a little too absurd to believe. They're much higher than anticipated, and the way they're calculating this, doesn't make a lot of sense. So we view this as a negotiating. This is the opening round of negotiating deals between the countries. Both Trump and Treasury Secretary Bessent, they were pretty in forthcoming in their language about how they would be open to reducing the barriers if other countries followed suit. They've given themselves some time, initial tariffs on autos now, and extra tariffs starting in about a week or so. So we feel like they've given themselves a lot of wiggle room in terms of these negotiations, to get things done. Some countries have already got in line to negotiate. Some are contemplating retaliating. Canada's put their tariffs on, non-USMCA compliant autos later or earlier today. So there's going to be some back and forth. We think, this is, step one of a bunch of deals getting done in terms of negotiating these trade tariffs. So I think this isn't the final version. I think there's, the market's obviously reacting, as a bit of a shock, but we think there's going to be the story's not fully written on a lot of these tariffs here, and that there is going to be deals done with Canada, the U.S., Mexico, Europe, throughout the world. So that's what our current thinking based on the current tariffs are.
Well, maybe I can just add that to Ryan as well. So, I mean, if you look at what's going on the 5th, he's gonna implement the 10% tariffs, and then on the 9th of April, which is the I call it the penalty tariffs, where the enhanced penalties are included at that point in time. So the stuff with Japan and China and things of that nature, you'll go from 10% to the higher number that we all saw from late last night. So that tells us there's probably wiggle room for negotiation. So there's a standard 10% on the 5th, and then the penalty tariffs that will occur basically on the 9th of April. So we know already that there are conversations going on with some of the countries. Our information is telling us that Mexico and Canada are already in talks, as well as other countries as well. So there are things going on, and I suspect, or we suspect, that there will be some conversations or communication over the next several business days with some of these negotiations taking place. We should also mention there are some exemptions with the tariffs, things like copper, pharmaceuticals, semiconductors, certain type of minerals, energy products, and so forth. So there are some exemptions as well built in to the tariffs.
Yeah, absolutely. I think this is sort of and the Treasury Secretary commented that this is the high end of what the tariffs would be if the countries aren't willing to come to the table, and I think a lot of countries will opt for that. And again, I don't think this was. I mean, I believe it's a serious proposal, but I believe this is definitely a tactic, by the administration to get people to negotiate. Always sort of start high and work down to a more reasonable sort of level. So, and we think that, the Trump and, the Republicans have midterms coming up in the next year, and like they don't want to, they want to retain the House and Congress and retain power in their majority. So I think, if they're really going to push these tariffs too hard and cause some damage, then that opens the door for the Democrats again in a few short months. So I think this again. This is the start of the negotiations. I believe we'll see some delays. I believe we'll see some concessions and some bargains made, and then this isn't the be all and end all of the tariff situation.
Also to mention, and Ryan, is in the executive order, it does state in Section C that Trump is willing to is encourage anybody to modify or bring proposals in. So it tells you that he wants to negotiate. So it's right in the executive order. So we know that we believe this is kind of a tactic to negotiate and either eliminate or reduce tariffs significantly.
Yeah, and they put that language in there that if they feel sufficient progress has been made, or that they've given themselves again that wiggle room to get some concessions, or sort of make a deal and move on from there. So yeah, there's definitely I, the story's not over yet on these tariffs. I think that this is, again, a shock, but I think things will get worked back, whether it's through delays or through actual deals getting done relatively quickly.
Okay.
Um, on a lot of the tariff scare and, a lot of the market reaction is on, you know, fear that this is going to tip, whether the economy into recession or, really stoke inflation. Right now, the data we're seeing, whether it's jobless claims, the unemployment rate, private sector payrolls, consumer spending remains really positive. We see the U.S. economy in a good place. Obviously, you know, if the tariffs in place now were to remain permanent, that would definitely, sort of change the calculus. But we think right now the U.S. consumer and the U.S. economy is in good shape. And with the ongoing negotiations, it's going to continue to strengthen. And I think you're seeing, all the growth numbers revised up in the U.S. on their GDP. Services PMI numbers from the S&P up from 54 to 54.4. U.S. industrial production still ramping up. So you're seeing a lot of the data that's coming out currently still positive for the U.S. economy. So right now, we're not seeing a recession sort of in the cards. But I think, our discussions have been we're going to wait and see on these tariffs and how, if they get negotiated, and if they get repealed, what the ultimate impact will be. But right now, as of right now, the consumer in the U.S. is still very strong, and we're not seeing a recession on the horizon.
Guys, this is really important because at the end of the day, we have to rely on data. If the data is telling us that things are looking good in the US and things are strong, we have to make our decisions based on that. And so when you look at this report card that we've gotten so far, everything's healthy there. Now, we were talking earlier as a team, and it's like a quarterback on a football team, that our game plan right now is that we think offense is still the right strategy as we move forward. So we have been buying today and other days as well, and we will continue to buy. But if we see things change in the data, we're going to make an audible call and possibly pivot in a different direction. But again, we don't see that today. We still think this is a great opportunity to buy. But if the data starts to change in a way that we don't like, we'll be reposition the portfolio at a later point. But as we speak today, we like this in the sense of buying opportunities. We see this as a discount on some of the best companies in the world, and we are buyers, not sellers.
Yeah, I think that leads into sort of the next point that and again, we might, Diego, Mike, myself, and the other advisors might be a little bit of broken records about some of these companies that we've been, so passionate about and holding for a long time. But, for a company like Amazon, they have a huge AWS business, which isn't subject to tariffs. And regardless of sort of what gets put on tariffs, the shift to the cloud and cloud computing and the AI adoption is not really going anywhere. And, sales of 637 billion, 100 billion in cash sitting where ready to be deployed. They're still growing between 10 and 15% sales and earnings. And the multiples down. So, you're getting a 20, 30% discount on these companies from where they were just months ago, on this sort of fear and pessimistic outlook. Same with Meta. We're seeing discounts across the board, well capitalized, fast growing companies in areas that aren't necessarily affected by tariffs or, are in a position to absorb that. Even Apple, we feel like ultimately they're making the decision to, invest heavily in the US, to sort of circumvent some of those tariffs and to sort of get their supply chain back. And they've also committed to a huge amount of buybacks of their shares. So we feel like there is support, for the stocks at these prices, and companies will be looking to deploy, some of that cash into their own stock. We're still very comfortable with all, and these are just an example of three companies that, form, part of the core of our portfolios that we're really comfortable holding. And again, we don't have to worry about these companies. We can sleep at night with, their balance sheets, with their prospects, and they're all part of those secular theme of AI one way or another. So, like Mike said, I think this is a good opportunity to be buying. I think this is a discount. Stuff is on sale, and when these are some of the companies that we have the highest conviction in, I'll be looking to add more. And I think offense is the right strategy for now, until we see otherwise, until the clarity is there in terms of the tariffs, and the economic situation. But right now, we're still seeing things as pretty positive.
Yeah, so just Ryan, maybe I want to remind people, Meta about 2 years, 3 months ago, we were buying it at under $90.
Yeah.
That's where it was. And today, even at the close today, I think we're at 531. So remember, we've seen this before. We've seen the market drop, and you look what's happened. It was a $90, under $100 stock, and in 2 years and 3 months, we're up 5 times. Same thing with Amazon. I think Amazon was somewhere around $90 two years and 3 months ago, and now it's $180 with this pullback. So these are opportunities. And I remember even 2 years and change, people were questioning some of these companies, Meta in particular. They're saying, "Why are you buying it? It's under $100. It's over." Well, it's gone the opposite direction, right? So we look for companies who have a great balance sheet, that are growing their top line and bottom line. And in this case, we're looking for companies also that aren't affected by the tariffs. And so when you look at these great companies, we know that they're all everything, the good and the bad get pulled down, but the good always comes back, and it comes back even higher. So we are buyers here. I mean, we only use three examples, but there's a list of companies. I mean, we haven't talked about NVIDIA. That was a big win for us back 2.5 years ago, which is also in your portfolio. You look at Broadcom and a number of other companies that we own. I mean, we bought Bank of America, for those you may remember, at $27. Even now, I think it's around 38. And Brian, if I'm not mistaken, that was about a year and a half ago. So
Yeah.
even with the pullbacks, we're further up than we are down. This is healthy and part of the process of a bull market. It's unfortunate that it's self-induced by the President of the United States, but I think this is something that will be over in the next several weeks, and then we'll see the markets move a lot higher over time. So again, great companies is what we're looking for. Good balance sheets, a lot of cash, as Ryan mentioned, that are growing their top and bottom line numbers. And so if anything, they're on sale and great opportunity.
Yeah, absolutely. I mean, I think maybe, just to touch on the same thing with playing offense, just, you can't miss those, those good days in the market. Selling at the when there's peak fear really just hurts your return. And we think this is, it turns out, the good days are the best days in the market. You usually follow the bad days. So, we've had a few, weeks of bad days in the market, but we think that, if you do stay invested, add more, and be looking to add to your investments and buy the stuff that's on sale, you'll be rewarded for it over time. Especially if you exclude those top 10 days where things bounce off the low. You could easily see, the time it takes to get back to your high watermark after the drop extends significantly if you sort of sell at the bottom. So those best days are ahead in the market, and we think whether it's tomorrow or in the next few weeks when we get more clarity, we do see the market rebounding. And if you're out of the market at that point, you've really prolonged that return to your high watermark that we set earlier this year when the market was pretty strong in the first 6 to 7 weeks of the year. And
This
that
is that,
touches on.
that slide right is important, though. I want to stress that. I know there's been a couple people say, "Oh, should we get out of the market?" And this is crucial. You miss the top 10 days of the market, you go from 8.3 down to 4.9. You miss the top 20 days of the market, you go from 8.3 down to 3%. You miss the top 40 days, you go from plus 8.3 down to 0.1%. So we want to be active we want to be buyers of the market, and we want to stay in the marketplace, especially when there's a pullback like we've had of late.
Yeah, and even in good years, a comment we hear is, well, the market's come off so much, it's almost time to write this year off, as we've already had such a big decline. But even really strong years in the market have had, pretty significant 10-20% drops, throughout them, and end up being positive. I'm not saying this year is going to be a 44% return, but we still feel positively about this year. And we see this as an opportunity to get things on sale, to get great companies, and that's what's going to win over the long term. So even though we've seen volatility in the year, it's not time to just, pack it in and say, 2025 is, too volatile, or we're done with 2025. There's too much going on. Even in great years in the market, you can have, pretty significant declines within that year. On average, we see, 2-5% declines every year, or, 1-10%, 10 to 15% decline every year or so. So we're sort of in that range where this, like Mike said, this is a correction, and we think it's a correction as part of an ongoing, bull market. And these companies are still going to grow their top line regardless of the tariffs, which we also think will be rolled back at least to a pretty significant degree at this point.
Rana, you sent me a little attachment earlier today where it showed where the markets were down about 3% or so in the month of March. Even though in the first quarter, what the results were at the end of the year. Can you share those stats, or do you remember them?
Yeah, I do have it, but I won't be able to share it right now just because it's at the
Yeah.
last minute, right, of this whole thing. You got to remember that we're only gone 3 months in a 12 months year. All right, you've still got another 9 months to go. Okay, there's a lot more that can happen, and the question that you got to ask yourself is why, right? Why now? Okay, why is he doing this? Why is he doing it now? And then the question that everybody wants to ask is what next? Okay, so a lot of the things we won't know, but the why we do know. The why is very simple. He's trying to get revenue into the US. That's simple as that. All right. And the trade deficits that they have with other countries, well, he's trying to get American goods out there. And you can see from it, the speech he gave, if you notice, the people that he had at the speech were UAW workers, union workers. Just remember, during election time, those were the people that were against him. All right. So now they're all for him. So it's trying to bring that back. That's why. Why now is very interesting because he's done it in the early part of his election years. All right. So it's basically when a new CEO takes over a company, he tries to clear the mess from the previous CEO. All right, so you do all the damage at the beginning, and then later on you get all the gifts and everything. All right, so that's part of the why now. I'd rather take the damage early, clean it up, and then I've got 3 years to try to, make myself look good. Right? Literally every CEO is down to the what next, right? This is a hard one because we can use Trump 1.0 as an example, and I know I gave Ryan. If you got my slides, I'll
You
put
know
them
what?
up
Yeah,
here.
that'd be great. I'll pull up your slides, Rana. Why don't we do
Yeah,
that?
okay, and there's a lot more details in that, but the what next of it? Trump 1.0 gave us an example, all right, and in this one here, what he's trying to do is enhance Trump 1.0 because there's mistakes he made in the beginning. He's been talking about these tariffs for decades. Like since he was 30 years old, he's been saying this. There's lots of interviews where he's talked about this. So this shouldn't be a surprise on it. So I'm going to start this up. If you can cite it in presentation mode, it'd be easier.
Yeah, I'll get
While you're
get
setting
going.
that up, just or maybe something for people to think about. I mean, there's really three things that the other governments can do. One is accept this and live with the increase. They can retaliate and increase it, which means there will be reciprocal increases from the U.S. and you're going to play that game, or they negotiate. And so, I mean, if you look at the three options, those are only three options that we see at the end of the day. So either accept it, retaliate, or negotiate. So if you're in our opinion, the odds are towards negotiation. Most of these countries are either have or starting to negotiate a new deal and trying to bring the tariffs down. I'm not happy with the way things are going. I mean, I'm not saying I hate Trump. I'm not saying I love him. I don't want to make this a political discussion. But at the end of the day, we have to look at what the options are for the other governments. And those are the only three: either accept it, retaliate, or negotiate. And we really believe this is a negotiation strategy for them. And I think once we see this occur, you will see the markets kind of rip upwards at that point in time. So patience is key here. Go
Yeah,
ahead,
so
Rand.
I want
Go
to
ahead.
give this opportunity only looks like opportunity looking backwards. Today, it's risk. So you're getting a lot of noise that's in the market right now, and it's all opinionating. Everybody that's getting in here is saying this is what it means. This is what it means. You're hearing a lot of dire talk. This is going to lead to a recession. This is going to lead to a trade war. All right. So you get the extremism of words. All right, stagflation has been popped up. Stagflation, the last time we saw stagflation was in 1970. All right, and yet every year they talk about stagflation, right? So Ryan, just keep on popping going forward, right? When you look at tariffs in history, they're very small, the event at that time. And I'm going to take you back, and Mike, I'm going to take you back 5 years from today. 5 years ago today, you were worried about something way more than Trump tariffs on things. All
Oh,
right. You were worried about where do we get toilet paper from? Okay. You were worried about what's this new thing called a virus. Okay. So, and yet that singular point, April the 3rd, 2020, was one of the best days you could have bought the market. It looked horrible because you just had a 20 odd percent drop. And at that time, nobody knew what was coming up. Just like now, we don't know what's coming up. So when you get these kind of events, when you're in it, it looks very extreme. But looking back, you're going to start to see the opportunity to it. Next one, please. Right, if you look at the history of Trump 1.0, like you had a lot of tariff talk during that time. 2018 was a lot of tariff talk. Then you had COVID. Yet over the whole tenure, he gave you a gain of 67.82%. Now, let me give you what that means on average. Per year, the markets went up 14.8% per year. Now, that's including a big drop in 2018 of 20%. All right, so let's put some of this. We're going to have, we just had 2 great years. 2022 was nasty. Then you had 2023, 2024. We're overdue for a 10, 15% correction. We're overdue for that. And that's just a normal part of it. And then it'll start to shift over to the next thing. These tariff, he's literally named it, but it's very important that you look at the sequence of the companies. So at the very top, he put China, then he put a European Union, then he put Vietnam, then Taiwan, then Japan. If you notice, this is the route that he's taken. That's because he's actually after China. In Trump 1.0, he was after China. China got into the World Trade Organization in 2001. They went from a 20% tariff to zero. So China has become rich, the second largest operation in the world, because they haven't had to worry about tariffs. Okay, so there's an unfair advantage in here. All he's trying to do is take care of that. China is no longer an emerging market. It's the second largest economy in the world. Why is it in the emerging markets bucket? All right, so there's an unfairness going on here. And I'm not saying he's doing it right. And I don't even agree with his calculation. His calculation, by the way, is wrong. 67% makes no sense at all. I've tried everything. It's basically what he did is exports minus imports, right, divided by the number of exports. So you're taking the trade deficit divided by the number of whatever they're importing. And so that's how you come to 67%. That's not quite true. All right, so understand there's a little bit of cooking on these numbers, but his general message is right. Next one, please. Okay, if I think Tesla changed the whole auto industry. Tesla proved that you can manufacture a car 100% in the US and cheaper. All right, so in a way, Tesla has destroyed Ford, GM, Stellantis, and everybody else because of its manufacturing process. So why is Trump saying bring your car manufacturing back to the US? Because he's actually got a real good example of it happening. And so you will see more and more factories actually come back. It'll hurt Canada a bit, but you're actually going to see more of the injection molding that Tesla does and the robotics side of it happening at other car companies. Next one. All right, so if you look at the tariffs of the US, all right, so this is going to show you what they've been dropping, but after World War II, if you look at 1940-45, you saw a dramatic drop in tariffs, and that's because the US tried to help the world. Because of the war, they needed to give tax-free or lower tariffs to Japan, the rest of the world, to help them recover. That was part of the whole the act that they had, MacArthurism, right, to give that there, and that's why Japan grew. And then in 2001, right, you got China coming in, and they dropped the tariffs again. And only in his first term did he raise it up again. And now what he's done, he's brought it back to pre-war levels. All right, so he's trying to say, look, you guys have recovered now. You guys have improved. Now it's back to us going back to the normal route, unless you bring your tariffs down as well. So it's a reciprocal tariff, not a higher tariff. And what he's trying to do is get everybody to go to no tariffs. Okay, but without saying it. Next one. Okay, so this is term for his first term versus this term. And you notice that in the first term, also he had a drop when he first did tariffs. And we have a larger drop now because we had two fantastic years before that. All right, now, if you notice in the first term, it began to rise. Then he mentioned tariffs again. That was the second negotiation. And then you saw a drop, and then you had another part of negotiations happen, and then finally in his first term, the blue line, you see the last negotiation where they signed the agreement for it, and then the markets took off. So it's a three-step process. First, bring him to the table, let's have a discussion, get to middle line, they go back, they argue it, come back, and then so term one is a perfect example of where he's going with this. Okay, next one. And here it is. This is the overlapping of term one, Trump 1.0 versus Trump 2.0. You've had a larger drop, and that's because there are more options trading in the markets now than was in 2017. But the timeline is almost perfect. All right. March, mid-February to March, mid-February to end of March. Then you see the rise. Then you see the second negotiation. It rises, and then you see the third negotiation. This is textbook Trump. I've read The Art of Deal 3 times. This is exactly what he does. Okay, next one. Okay, so now let's take a look at NASDAQ because everybody's worried about all these tech companies, everything. Remember, I told you that you had a big drops in the first term. Trump 1.0 trade wars is the first term. You had a large drop then as well. And yet, 2017, first year was 16%. 2018, you had 2 drops of almost 20%. One drop of close to about 19%, and the other one was 20% in September. And yet the market, NASDAQ finished +4. 2019 was the year after a midterm. That was a 42% increase. And then 2020 was it. So this president is, it basically think of a child having a tantrum. All right. But a child with a huge ego and attention seeking child. All right. So what you have is an attention seeking child having a tantrum. And now we've all had kids here, right? So Diego, when Melissa was having a tantrum, what did you do? All right.
Yeah, I spanked her, but I don't think I can get away with that now. So,
You didn't spank her, you talked very nice to her, you calmed her down, and you negotiated with her. No, you can't have that chocolate. Right? Essentially, that's what's happening here. We've got a tantrum-filled child that wants attention, which he's getting, and then you appease them a little bit, then you're kind of gone. But you had 4 very strong positive years. Right now, NASDAQ is at minus 11.68 as of today. We're only at the beginning of the year. Okay, next slide. So why is this happening? This is very important. I don't think anybody's talked about why this is happening and why this is happening now. And it was kind of leaked by Scott Bessent. If you listen to him, he kind of leaked it and then he kind of regretted saying it. And we fought it. We had the discussion. Go ahead, I'll explain it. This year, you have $10 trillion of debt maturing this year. 7 trillion of that is maturing before July. Very, very important. $7 trillion of US debt is going to mature before July. If the interest rates are higher, that's a big problem. And go to the next slide. All right. So this is important, and I want you to click through this slide here because I'm showing you the 9 trillion of treasury debt. No, don't click all through it. Go back up to the top, just the first slide as I talk. So what plan here is Scott Bessent gave this plan. Great uncertainty and volatility, right? So do this earlier on. Why? Next one. Investors panic and they go into bonds. Next one. When you go into bonds, that lowers interest rates. So you've just seen the 10-year yield drop to 4.03%. That means that if they issue a new debt, all right, and remember I said 10 years, what's maturing is 5-year debt because in COVID, which is exactly 5 years ago, they borrowed a lot of debt. And you now have the ability to take a 5-year mortgage into a 10-year mortgage. If you look at this chart, you will see that in 2035, there is no debt maturing. So what they've effectively done, Scott Bessent is one of the best hedge fund managers ever in the world, and he's on the Trump team. He is going to take this 5-year debt, convert it into 10 years. So the next worry is 2035. But why? Because it lowers interest rate, that leads to a higher demand for housing and borrowing that stimulates the economy and it counteracts inflation. And you don't need power for this. All right. So it doesn't matter what Powell says, you've already created that. And this is a bigger problem then tariffs. All right, 9 trillion has to be sorted out today. All right, it can't wait till August, September. So there's a story behind the story. All right, and this is it. Drop it down, get rates low. Then after that, after July, you're going to start to see deregulation and the income tax reduction. All right. And then after that, you'll start to see interest rates drop, from which Powell is now saying, which is going to be 2 drops. So you've got this huge, powerful cycle coming up. Deregulation of banks. So on April 11th, you're going to hear from JP Morgan as a start. Very important to hear what he says. Deregulation means that big banks can turn around and buy small banks without going through the government regulations. All right. So you're going to see that. You're going to see JP Morgan, or I'm not going to say a company, any bank, as an example, can now buy international banks without going through regulation. This is why Europe has to be hit. Europe is on the trade block, or on the things, because they put all these regulations on Google and Meta. All right. Whatever. So by instead of hitting them with trade, he's going to say, I hit you with trade. But if you reduce the penalty on Meta and Google, remember these were the guys at his inauguration, you get into a better territory with tech companies. Go ahead now. This is a
Rana,
key part.
Rana, this is relevant though, because we've been talking about equities all the way through. We haven't really talked about fixed income and balanced portfolios. And unlike in 2022, having the interest rates come down has actually been very positive for the bond market, and it's kept our portfolios fairly buoyant. And so it's something that we're monitoring fairly closely, uh, because that bond component has actually performed relatively well. Again, unlike 2022, where we're in a rising rate environment, it really both dropped at the same time. So I think it's important that people understand that it's not just about the stock market, it's about the portfolio and the holdings within your overall holdings. So I want to make sure that people understand that.
Good point,
Right.
Diego.
So you're at crossroads right now. You're seeing this drop in the markets. Now, if we go back into history around drops in the markets, there's 2 ways the world can go. If it's a recession or it's not a recession. And remember what you're seeing. You're seeing dropping interest rates. You don't have a recession when interest rates are dropping. You have them when they're rising. That's what 2022 was all about, right? So again, same thing with COVID. It had a recession because interest rates were rising, and then they had to drop it. That is. The other thing that you're having is, Mike, I don't know if you've noticed, have you noticed the oil price going up or down recently when you go fill up your gas tank, your giant car?
Down.
Down, right? Well,
Yeah.
you don't have a recession when the oil prices are going down.
Right.
Okay, so realize what he did. Trump went in 2 weeks ago. He went into OPEC and said, OPEC, I need you to drop prices. And then everybody missed out what he said after that. Or else. All right. And the or else is, hey, tariffs are going to hit you pretty hard. If you notice, there wasn't that much tariffs on the Middle East here. Morocco had 10. Everybody was low. That's because they did obey. So this is about putting out a message and have a big. But the key thing here is if you look at timelines of drops like this, roughly the recovery happens at top to top is 150 days. That means that if this holds to a standard no recession recovery, then 150 days from now, all right, that's roughly about 5 months or so from there, right? 5 months from now, so we're in April, May, June, July, let's say August, July or August, you see the top again. But when does that recovery start? The recovery starts actually 60 days. All right, so the actual peak was February the 19th. So 60 days from that puts it at April 24th-ish. All right, so that's when it stops dropping, when there's no reason for it to begin to drop further, and there's all this cash on the sidelines begins to come in. So everything has a process. And I always say that when you have a crash, we don't know when you have a market drop, we don't know when it's going to happen. Just like I don't know when you're going to break your arm, but I do know what to do once you've broken the arm. You put a stint, you put a cost, you put a sling. 6 weeks later, you're back to recovery. All right. If you haven't done anything stupid. So we're in that same process. Right now, we're trying to put a splint on it. And the splint will last for a while. It'll last maybe a month or so towards the end of this month, and then it'll start to move upwards from there. Okay, next slide.
Ryan, that's a good point, though. There is a lot of cash on the sideline, and the number that we have is 8 trillion on the sideline, and that's going to be put back into the marketplace at some point. And
About 2 to 3 trillion of that will come back into the market. There's a natural high of cash of 4 trillion that has to remain no matter what. And that's because it's held within the banking system. Okay, so that's the part to it. Now, if you look at the history, going all the way back in history, this is cycles that you use 1 year, 4 years, 10-year cycles on it. Basically, it's the post-election year. You will start to see that almost at the end of March to April, you have a low. Then it rises, and then you're going to have another piece of worry coming up. This is just history telling you this is going to happen. Okay, next slide. All right. So look, we're at the very beginning of 2025. Right? We've still got a whole year to go. Okay, and we're all panicking. Just like I reminded Mike, what were you doing 5 years ago? I'm gonna remind Diego, August the 5th last year, we heard about something strange called the yen carry trade. Nobody knew what that was either. And there was no Trump then. And the markets fell then as well, right? Every year we're going to get some nonsense. All right. The key thing is that Ryan, Diego, Mike, Eric, Tom, right, is that the companies that you own, they're going to last longer than Trump is. Trump will die out before those companies ever die out. All right. So these companies plan for this stuff. All right. In this morning in my Goldman Sachs meeting, they told me something called transfer pricing locking. So when a company builds a product in Vietnam, they do transfer pricing with them. So this is called, and they through swaps lock in the price of that item coming to them, irrespective of tariffs. So these swaps are there. That means that from January to next January, even if prices go up, it doesn't impact the company. So transfer pricing lock-in has been done in January because they were worried about Trump coming in before January the 20th. Companies are not worried, but they'll use it as an excuse to boost up profits. Next slide. And this is the last one. Warren Buffett says it the best, never bet against America. That's the end of my talk.
Thank you very much. We do have a few questions that I've been getting along the way here, and one had to do with likelihood of a recession. I think that's been in the media a fair bit, along with inflation fears and whatnot. So, just want to know your thoughts on, and Ryan, yours as well, or even Mike or anyone within the panel, thoughts on the likelihood of a recession and will these tariffs put us in that situation?
I'll start off with Canada. With increased layoffs, there's a likelihood of a recession in certain sectors. All right, we're already feeling it in the real estate sector. All right, so the way out of that is to drop interest rates. That's why oil prices are also dropping. It came up because of carbon tax. In the US, not likely. All right, they turned to a service economy. They're trying to get back manufacturing. All right. And so, no, and people start saying to me, well, I'm not going to buy American goods. And I've got one answer to them: turn off your Netflix. Right? Netflix is American. So you really can't turn it off, right? Stick to CBC. It's hard to not do service companies. So the answer is US, unlikely, Canada, high probability.
Yeah, so I just want to echo that. Just first of all, the data Ryan brought together earlier mentioned about the stability and strength of the U.S., but also in the portfolios, we are overweighted U.S. We are concerned about the Canadian economy, at least for this year. So there could be certain sectors or industries that may go into recession, or hopefully not the whole country, but there are some concerns there. Based on the data we see right now, guys, we don't see recession in the U.S. But again, as I mentioned, if we start seeing data that does not look favorable, well, we'll be making changes. But right now, we like the U.S. over Canada, and also abroad, outside of North America as well. We think the U.S. still has some upside, a lot of upside from where we are right now. So I don't know if anybody wants to comment on that as well. But again, we have been overweighted U.S. and we remain overweighted U.S.
Yeah,
And
I think our only concern is currency. We were anticipating that the U.S. dollar would get a little bit stronger. It actually did the exact opposite over the last couple days. So again, I echo Mike's opinion, as well as Rana's. We're favorable when it comes to U.S. We think the U.S. economy is still running full steam, and has lots of opportunities. We do have reservations about the Canadian situation and where they're going, and the likelihood of a potential recession that could hit. So I do agree with that.
I have a question here too, from I don't know who it is, but from a client, and they're just asking. I mean, if this is a great time to buy, if we're invested, where's the money coming from in the portfolio? If I'm reading the question right, if I'm wrong, please ask again. But where's the money coming from in order to allocate towards equities? So does anyone want to take that, or do you want me to
I,
start? Or
I I can take that. I mean, we came into the year with a little bit of cash. So that we've deployed some of that. We've reduced some of our Canadian fixed income, that's performed pretty well with the rate cuts. So we've reduced that a little bit, and we had some hedged products that we're doing some option strategies that we've reduced as well in favor to sort of pull into some of the stuff on the sort of the outside of the portfolio to move more into the core highest conviction ideas. So we've pulled from a few different sources for the cash to invest.
So, Ryan,
Yeah,
maybe you can talk about even that hedge fund, just because I mean, we added that, I think, late last year
Yep.
in anticipation of, in case the markets had a pullback, to be able to use it. Maybe just talk about it, just generally how that works, so they get an idea of the strategy and why we did it. It was more a defensive play for us.
Yeah, so it's still the strategy holds, it holds some equities. It holds around 30 to 40% equities, then the rest in cash, and then the rest they sell options. So they're selling options into the market, hoping to buy stocks at a lower price. If stocks go down and those options get called, they get to buy the stock at a lower price. And if it doesn't, they collect the premium on that. So it's got not a lot of market exposure. It's a little more defensive and it pays some income, but there's still some upside in the market there. So we thought as a sort of mix, as an alternative strategy between equities and fixed income, that would be a place to go. And we've sort of sold that off as we see it held up well during the downturn, and we see a pretty good opportunity to add into, our regular equity strategies. So that's some area where we've been finding cash.
I think we
yeah.
called it Trump insurance, right? Just in case. Oh,
The other thing, Mike,
we just sold it. Yeah.
yeah, Mike, on that question, I'll expand it a little bit. I think if people do have cash, when do you deploy? When would you consider sort
Mhm.
of adding to your positions if you've got spare cash and whatnot? And so, I'll throw it out to the panel as to what their thoughts are. And Eric, I don't know if you want to chime in or have any thoughts on that. So,
Um, my thinking as we're going through this presentation is we never talked about fiscal policy, right? And I think that's going to be an important component going forward. We've seen parts of the EU, Germany specifically, actually come out and increase spending. I think we're going to see the rest of the world probably have large fiscal spending, and inherently not great long term, but in the short term does prop up economies. So I think that is a big component there.
Thanks.
uh, Ryan, as far as or Rana, Mike, I don't know what your thoughts on are as far as utilizing cash now. If you've got extra cash floating
Just, I
around.
mean, Eric, you and I were in some meetings today as well. I had some others from the office at the same time. I mean, we've actually had clients send a lot of new assets over. People who are sitting with cash on the sidelines, putting it to work. So I'm suggesting that we're doing that within your portfolio. But if you're sitting with significant cash outside or any cash outside that's not required for lifestyle or big purchase in the next little while, it is a good opportunity to buy. I personally have bought a whole bunch of stuff of late as well. Had some money allocated for other things, but made a decision to deploy it into the markets as of today. So I see this as a buying opportunity. So if there is some cash on the sidelines that you do have, this is the time to buy.
My thing is, look, we'll never know exactly what is the lowest day. You know that if you dollar cost average along these volatile periods when fear is high, eventually you get to the point where fear is not there anymore. All right. And I don't know how long it takes, but this little bit of buying along the way compound so much faster when you have that period and we look back behind us and we say, oh, what was I thinking during COVID? Right? What was I thinking when when inflation went to 9%? All right. What was I thinking when the war started in Ukraine versus Russia? All right. Remember all those panic moments, right? And yet when you look back, those were the moments that you wish you had dollar cost average along that bottom period.
And that's a good point. So again, the clients that gave us money, we are allocating about a third, depending on the client, 25 to 30% now. And then what we've agreed to is slowly average in over a period of time. Usually we do it over a longer period of time, but if we see this market starting to bounce back up, we may shorten that duration of the dollar cost averaging in, but we will be watching for buying opportunities. So I would not buy all today. I would definitely do it over the next either couple of weeks or the next month or so, and make sure that it's fully vested. But again, be selective. There may be another bad day over the next couple of weeks, so we want to have some powder available for that.
Yeah.
Listen, I don't see any more questions unless there's. I don't know if you want to go around the table really quickly. Anybody want to add any comments or thoughts, and then.
Yeah, I'll start off, Mike. Today was a tough day. We spent a lot of time, doing a lot of research, talking to a number of different people, just trying to get a flavor of what's going on. And while there's no perfect answer right now, I think a lot of people are shell shocked a little bit. We think the tariffs were overdone significantly, and consequently, it's been reflected in the market as of today. But I do agree with some of the comments that have been made throughout this roundtable that there's still negotiations to happen. A number of countries have already started the process, and so consequently, once we get through that, I believe that with some of the economic data that Ryan shared early on in the presentation, the markets will get back to a more normal situation, and not the volatility. Over the last 3 or 4 days prior to today, we started negative and we finished positive, which is unusual, but it just showed that uncertainty as to what's going on. And I do believe that's the biggest fear right now, and not knowing exactly where things are going. So once we can move through this, and again, I agree with I think it was something Mike said or Rana said about the midterms are really relevant, and it's going to be important that the Republicans smooth things out a little bit if they want to control both the House and the Senate in the midterms, and they're going to have to do that sooner than later. It's not going to be an extended period of bad news, so it's going to be a critical piece. So. Cautiously optimistic is the term I think Mike you used early on, and I echo it, and I agree. And so we're trying to take advantage of buying things on sale, and number of companies that we talked about are significantly on sale and provide great opportunity. We know in the next year or two they will be worth more than what they are today. So want to make sure that we're doing the right things for the portfolio and for our clients.
Yeah. Maybe I'll say something, then I'll pass it on. So, there's two ways you can do this as an advisor. One, we can hide and hope you don't reach out to us. we made a decision and we want to be in your face. We want to make sure that we're communicating. So today was unexpected, unplanned, and hopefully you appreciate it. But we are available for anything you need from us. There will be another video that's going out, Ryan, that I think hopefully it's on in the email as well. It's not this one; it's a separate one that we got prepared. We were hoping to have it out earlier, but it came out later. Just again, everything's been a little bit rushed. If we need to, we'll do another one. We'll do another in a week or 2 weeks from now. I mean, during COVID, Diego, I think we did one every week almost.
Yeah,
We'll,
and we
we'll do
actually
whatever needs to be done.
yeah, we actually have a couple videos in the hopper right now. We're just we have an economist that provided us with some raw data that coincides with a lot of our thinking and whatnot that we'll share, and so we will get that out for sure.
Yeah. Anybody else? Thomas, you want to say anything? Eric, and Rand, I'll let you close.
Yeah, I can. You know what? I think it's important to remember the old adage: it's about time in the market, not timing the market, right? So, I mean, we're going to see these kind of dislocations in the market, you know, we also have to remember what our time horizon is. We are investing in a longer time horizon, right? And this is just part of that process.
Thanks, Eric. Thomas, anything you want to add?
I'm gonna say, please carry on spending your Visa cards. All right, please carry on going to Costco, and please carry on going to Netflix and shopping from Amazon and searching on Google. As long as you are doing that, I don't care what tariffs they're putting on. They could jack the tariffs up to 1,000%, but you're still going to be
Don't say
carrying
that,
on.
Reddit. Don't say that.
Yeah,
I'm just
bite your
telling
tongue,
you, those
bite your
things,
tongue, bite your
yeah,
tongue, Ronnie.
those things don't impact you. You're still going to spend Visa, MasterCard, and everything like that. The revenue might be a little bit lower, but they're still making revenue out of it. Okay.
Thanks. Thomas, you want to close then?
Yeah, I mean, you guys have all echoed some pretty good points, and I know we sound pretty repetitive in times like this when there's a lot of overselling that we want to be offensive and be buying a lot of these really solid companies that are out there trading at a big discount. But it's really times like these where we look back and say, "Wow, I should have bought this stock at $100, $90, whatever it is." But when you really broaden your time horizon and zoom out. It's times like these where being disciplined and being patient is really going to benefit you. So, I mean, Rana, you've said many times too in 2022 being a really it's a tough year, is a year where month over month it was just continuous bleeding and it was tough for investors. But we had the Russia-Ukraine war breakout, and for about a 4 month period we had a decline of about 16% in the market. So for people that wanted to be completely out of the market, you're selling at a 16% loss and therefore crystallizing your losses. Whereas if you would have stuck it out, been patient, and look over the long term, 3 years later, you're up about 24% as of today from the day that the Russian agreement was presented. So, yeah, again, we sound repetitive, but the strategy works, and we want to make sure we're staying disciplined.
Right. I'll close saying thank you very much for your trust and confidence. We take our job very seriously. We appreciate any feedback you may have. We want to hear from you. Do you want us to do more of these? If you have any questions, by all means, send them out to anyone on the panel, and we look forward to hearing from you. And all we say is stay on target, stay focused with what we have. We've been down this road many times, and this one's a small one compared to COVID, the financial crisis. So we'll get through it, and we'll be big winners at the end of the day. Thanks, everybody.